Top business stories live from the Sky News City studio. Calls for supermarkets to be held to account as an investigation finds bigger profit margins have cost drivers an extra 6 pence per litre at the pump. More than £12 billion wiped from the stock market value of AstraZeneca as results of a cancer drug trial disappoint investors. And pressure on Britain's banks to pass on interest rate hikes to savers. I'll be speaking with the chair of the Treasury Select Committee. Good afternoon. This is Business Live with Ian King. The Chancellor has promised to make it a legal requirement for companies to publish their petrol and diesel prices to help drive down prices. It comes after an investigation by the Competition and Markets Authority, which found that drivers have been paying an extra 6 pence per litre because retailers have pushed up their profit margins. The investigation was launched last July as fuel prices hit record highs in the wake of Russia's invasion of Ukraine. Well, data from RAC Fuel Watch suggests that unleaded petrol prices peaked at around 191 pence per litre last July and have now fallen back to around 143 pence per litre. For diesel, the peak was even higher, hitting 199 pence per litre. It now costs around 145 pence per litre. Well, earlier on today, I spoke with the Chief Executive of the Competition and Markets Authority about the measures they're recommending.
Found is that we have seen a weakening of competition amongst retailers for both petrol and diesel. We've seen that the margins for retailers have increased over recent years. And what we're seeing is that at the end of the day, that motorists are not getting the best deal possible. Motorists are paying more than they would be paying if margins had remained at historic levels. We think that we need to inject a real dose of extra competition into this market. That needs to happen quickly. So we've put forward two key recommendations to government today to take forward an open data fuel finder scheme that will make it much easier for motorists to find the best deal from their phone, from their car, without having to drive around from station to station. And at the same time, we think the market needs to remain subject to ongoing scrutiny, and we're recommending the introduction of a new fuel monitoring scheme to set that up. So what we've seen is that Asda in particular, historically has been the cheapest of the supermarkets. Back in 2022, they took a decision to increase their internal margin targets, actually treble their margin targets. We saw a similar move by Morrisons to double their targets. Now, in a market where competition is working well, you'd expect other retailers, other supermarkets, other fuel retailers to respond competitively, to seek to win market share. We haven't seen that happen at all. We've seen a complete absence of any kind of competitive reaction. Instead, the retailers as a whole have tended to track the price movements, and that's resulted in an overall increase in margins at the expense of the motorist.
Is it possible to look at supermarket fuel pricing in isolation, given how a lot of the multiples link in-store discounts to what people pay at the pumps?
Yeah, so we have been looking very specifically here, as you say, through our 12-month market study of what's happening in the road fuel market. That's enabled us really to drill down and get to the bottom of the decisions that individual retailers have been taking. That's very separate from the review that we're doing at the moment, looking at grocery prices more broadly. We'll be reporting back on that in a few weeks' time.
Now, the Liberal Democrats, in response to your report, have said they want supermarket executives hauled into Downing Street and stripped of their bonuses. What do you make of that?
Well, I think what we're really focusing on is making sure that we can work with the government now to improve competition in this market. We think there's a real opportunity to do that, to make sure motorists can get the best information possible, to be able to make the right choices, and to make sure that as a result of that, there's greater competitive pressure on these retailers that they have to offer motorists the best deal possible.
And in an ideal world, how quickly would this be implemented?
I think it's really important this is implemented as quickly as possible. We can see the detriment to motorists at the moment, so we will be absolutely working with government to take this forward as quickly as they're able to.
Well, the CMA said Asda and Morrisons made a conscious decision last year to raise their profit margins. Asda was also fined £60,000 for failing to provide information when it was requested. Well, Asda has responded this afternoon by saying, despite record inflation, we have carefully managed our business to ensure Asda was the cheapest traditional supermarket for both groceries and fuel throughout the period reviewed by the CMA, and this position is unchanged. Meanwhile, Morrisons has said the calculation of margin on fuel does not include the costs of running a fuel business, such as energy, rents and payroll, which have substantially increased through the cost of living crisis, while volumes have declined since COVID. Some other business news stories for you now. And shares of AstraZeneca have fallen by more than 7% today, wiping more than £12.5 billion from the drugs giant stock market value, as trial results for a new lung cancer treatment proved disappointing. AZ said that the treatment, Dato-DXd, had demonstrated a significant improvement in progression-free survival in patients with non-small cell lung cancer compared with the current standard of care chemotherapy. But investors took fright at AZ's failure to discuss the test results as clinically meaningful, and news that some patients treated during the trial had died. Well, more than 1 million people worldwide are diagnosed with advanced non-small cell lung cancer annually. The UK's manufacturing sector contracted last month for the 11th consecutive month, according to survey data published this morning. S&P Global CIPS UK Manufacturing Purchasing Managers Index, in which anything above 50 represents growth and anything below that a contraction, came in at 46.5 for June. That was down from 47.1 in May and was the weakest reading for the sector this year. Well, S&P Global said the figures reflected lacklustre demand in both domestic and overseas markets, with levels of output, new orders and employment all suffering further declines. Diagnostics company Yourgene Health has agreed to an £18 million takeover by its larger rival Novocyte Group. Yourgene, which is based in Manchester, was founded 10 years ago and provides technologies and services to enable genomic medicine. These include non-invasive prenatal tests and screening products in reproductive health and precision medicine used to test for cystic fibrosis. Well, the pair said today that their combination would create a more scaled, diversified operator in the diagnostic sector. And the excitement around generative artificial intelligence has started to have an impact on mergers and acquisitions activity among corporates. Last week saw nearly $2 billion worth of deals done, with the data storage and management firm Databricks paying $1.3 billion for the generative AI startup Mosaic ML, and Thomson Reuters paying $650 million for the legal AI specialist Casetext. But could they be wasting their money? Well, joining me now to talk about this is Fernando Lucchini. He's data science and machine learning lead at Accenture. Fernando, good to see you this morning. I mean, it's interesting to see sums like this being spent, but are these deals going to pay for themselves in the long run, do you think?
Well, thank you for having me first. Thanks a lot. It's a very interesting time. Some of these breakthroughs, I think we're still all trying to understand what they mean. We're still trying to apply them to the real world. We've got this balance of interesting and useful. Is it really interesting? Is it really useful? I don't think it's anything but interesting to see these sums being used, and how they will use them next, I think, will be even more interesting.
Is there an element of FOMO, fear of missing out here, going on?
I think so, and it's even worse, I think, for chief executives and companies who feel I think there's the most exaggerated FOMO, I think, in the history of technology, thinking, do I do something, do I not do something? But I do think it's captured the world's imagination, and I think it's also captured the executives.
It really has. I mean, it does feel like an inflection point here, all this talk about generative AI.
Oh, absolutely. And we have to remind ourselves that maybe 6 months ago, very few of us were talking about this, us AI geeks, and now 100 million people are hands-on keyboard, putting queries into this and getting things out of it. So it's not just a FOMO, it's a real, people are really using it.
But what's interesting, though, is that generative AI at the moment, it seems very good at language-based and creative tasks. It doesn't really feel that great on tasks such as data management.
Well, its superpower is that it understands language. And it is effectively like an enormous dictionary, something that understands language, but it has no critical thinking. It's some common understanding through large amounts of text. So yes, it's naturally very good at language.
But to what extent do you think businesses would be better off in some cases in trying to develop their own AI platform specific to their own industry?
It's a trend that hasn't really sorted itself. So on one hand, we have these enormous galactic-sized models, and then we have quite a lot of smaller-sized open source that we can all use freely. And I think we haven't quite figured out where we're going with this. Do we want the really enormous language that knows language inside out, or do we need a very industry-specific? We can put bets, but I don't think it's solved itself just yet.
Which industries do you think are being most transformed right now by generative AI?
It should be those that are very, very deep in text. So you've mentioned mergers and acquisitions. Mergers and acquisitions requires a lot of understanding of text, so maybe that's a good one. The legal profession is full of text. Pharmaceuticals are full of text and knowledge. So very knowledge-heavy should be able to use this to their advantage.
What about banking and finance? I mean, that's a sector that an awful lot of people are talking about in this regard.
Well, absolutely. They will come close second, third. I think we'll all be impacted, since at the core of it is an understanding of language, and we all use language all the time. So, but it is a co-pilot, people use that term. It is a little helper that was trying to help us manage our language better.
Are businesses doing enough to apply AI to what their activities right now? I mean, it doesn't feel as though it's completely widespread. It's very sort of uneven.
Well, thankfully, I think the Gen AI revolution has told the rest of the world that they should use AI more broadly. And we shouldn't confuse Gen AI is not equal to AI, is not equal to data, is not equal to everything. So I think it's time to highlight what have we not done in AI and why. Maybe we ask ourselves the question of why.
So, well, what's your theory? Tell me.
Well, AI is still a science. It's still hard to do. It's still quite scientific. It still applies to certain areas of problems, not all of them. And Gen AI, of course, all of us can put our fingers to the keyboard. As long as we've got fingers keyboard, we're qualified to use Gen AI today, which for maybe a simulation system for AI would have been requiring much more expertise.
All right, Fernando, we have to leave it there, I'm afraid. Good to talk to you today. Thank you.
Ian.
Still to come here on Business Live. The Treasury Committee calls on banks to ensure they're passing on interest rate rises to savers. I'll be speaking with the chair of the committee, Harriet Baldwin.
I'm Dan Whitehead and I'm Sky News' West of England correspondent. From fishing communities to bustling cities, we spend every day reporting from across the region.
The pound has rallied. Moderation, interest rates peaking.
Up at 6%.
The highest for 14 years.
Will that be the peak? Will it be a little bit lower?
It's closer to a potential crash.
So many words, so many meanings. But what do they mean for you and your finances? Stay up to date on Sky News.
I'm Stuart Ramsey and I'm Sky's chief correspondent. Well, there's a real sense now that people are beginning to expect that this whole airlift is coming to an end and they're really, really desperate. We saw snatch squads going in, grabbing people and putting them into trucks.
You either live and recover or you die.
Okay, so that's like a war.
That's the war, yes.
We help you understand the world with us.
Over the past 24 hours, the soldiers have been attacked on a number of occasions.
It's really sending a clear message that Venezuela is eager for change. We've been crushed.
We take you to the heart of stories that shape our world.
They were convinced the United States would become hooked. Well, they were right. An enormous explosion that's just come down. I think it was a monster that's just landed in between us.
The information on this could bring down the entire network, not just in Iraq and Syria, but across the world.
It's not out of control, but the pig withdrawn. It's so hot.
It's like Emirates. It's like better. Fly Emirates, fly better.
Well, equity markets in continental Europe looked to have made a good start to the second half of the year, but they've given up those gains as the session has gone on. There you go. Only the IBEX in Madrid and the MIB in Milan in positive territory at the end of the session. Talking points in Europe today have included Generali. Shares of Italy's biggest insurer have closed by more than 3% higher in Milan after the wealthy Del Vecchio family's investment vehicle was permitted by regulators to take a 10% stake. Well, here in London, the FTSE 100 is off to a losing start for the second half of the year. Gains for the miners have been balanced by losses in the healthcare sector and in particular in AstraZeneca. I mentioned that big share price reverse. That has wiped nearly 48 points from the index on its own. AstraZeneca off 8% on the day. The leading blue chip gainer was Anglo American, up by nearly 4.5%. That's after De Beers, in which it owns an 85% stake, struck a new 10-year diamond production agreement with the Botswanan government. Well, in the United States, stocks have been trading largely to the upside this afternoon in a shortened session ahead of tomorrow's 4th of July holiday. Among talking points on Wall Street this afternoon is Tesla, whose shares opened nearly 7% higher after it reported record second quarter vehicle deliveries. The shares have hit a 9-month high today. In the same sector, another electric vehicle maker, Rivian, it's risen by some 12% after its quarterly sales numbers also came in ahead of expectations. Apple, last week, of course, that became the first US stock to hit a valuation of $3 trillion. As you saw, it's off this afternoon. That's after the Financial Times reported it's been forced to cut production forecasts for its Vision Pro augmented reality headset. On the foreign exchange market, not a lot going on, really, to be honest. The US dollar has been rebounding from a tumble late last week. Sterling off 0.1% against the greenback, unchanged against the single currency. The euro, meanwhile, more or less again unchanged against the dollar. The oil price, though, there has been a bit of activity there this afternoon. Saudi Arabia has extended its voluntary production cuts. A barrel of Brent crude will currently set you back $75.99 a barrel. That's up a little over 0.75% this afternoon. With me now is Guy Ellison. He's head of listed equities at Investec Wealth. Guy, good to see you. I mean, AstraZeneca, you really don't see a move in a FTSE heavyweight like this every day.
No, and to put it into context, as you say, Astra almost single-handedly has dragged the UK market down at the large cap end of the index today. The mid cap in the UK, the 250 index, trading up around 0.5%, but the large cap end is flat. And just for context, Astra at Friday's close was the largest company in the UK market, just over 8% of our index, just slightly ahead of Shell. And today's fall, that £12 billion or so that's been wiped off the market cap, that's the equivalent of the entire market capitalisation of a company like BT or Next. Yeah. So, a very significant single stock move.
Extraordinary. Was the sell-off overdone?
No, I think the sell-off is proportionate, and it's in reaction to this phase 3 trial data of a new refractory lung cancer drug that Astra is trialling. So refractory drugs are those that you use when every other conventional medicine has been used, and you're really looking for a last possible chance to extend a patient's life. Whilst the data did show some success in extending patient lifespans, as you say, the data wasn't deemed clinically significant by AstraZeneca. This drug is important. Not only does it have potential applications in lung cancer, but there are also trials ongoing concurrently in breast cancer as well. And the market thinks the potential sales of this drug, if it gets approval, it could be up to $20 billion a year at their peak. That would make it one of AstraZeneca's key drug pipelines. And so what the market's telling you today is the probability of this drug getting full approval across a broad range of cancers now looks diminished. So it looks a proportionate response to what is potentially a very significant drug.
Yeah, no, I mean, this is obviously the start of the second half. Markets did well in the first half, equity markets, apart from the FTSE.
Yeah, and Astra today is a perfect example of why the UK struggled over the first half of the year. So, the UK market just up around 2% over the first 6 months of the year. Comparing that to America, the S&P was up 15%. The Nasdaq, because of the turbocharged performance from technology names, was up 30%. But actually, most European indices were up between 15 and 20% as well. So the UK really was the standout. And that is because of that really concentrated nature of the UK market. Healthcare is 12% of our market. Oil and gas is another 12%. Neither of those sectors managed to make any headway over the first 6 months of the year. And that means it's a really difficult job for the rest of the index to provide any momentum.
All right, Guy, got to leave it there. Good to see you this morning. This afternoon even. Losing track of time with these new schedules. Thanks for joining me. Now, the Treasury Committee has written to the chief executives of the UK's largest banks, calling on them to ensure they're passing on interest rate rises to savers. The Bank of England's main policy rate hit 5% last month, but data from the comparison website Money Facts Compare suggests that the average easy access savings rate is just 2.43%. Banks will soon be compelled to ensure they're providing fair value for customers when the Financial Conduct Authority's Consumer Duty comes into effect at the end of the month. Well, Harriet Baldwin is chair of the Treasury Select Committee, and she joins me now. Harriet Baldwin, good to see you today. I mean, the banks say they are increasing savings rates, particularly for some of these fixed-term savings products.
Well, I'm sure your viewers will have noticed that on the day the Bank of England raises rates, and they're raising rates to combat inflation, you'll get a message from your mortgage company saying your mortgage rate's going up effective immediately. But the banks have been very, very slow and very grudging about the increases in rates that they're paying to savers. In fact, we've gone so far as to describe the rates they pay to savers as measly. And we do recommend that people shop around and they really try and get some of these more competitive rates, which, as you say, are out there.
I mean, banking profitability has been crushed during the last 15 years by near zero interest rates. I mean, the banks on some levels can't really be blamed for trying to recoup some of that, can they?
Well, we think that they shouldn't be recouping their profitability on the back of their most loyal savers. So for our constituents who are perhaps not comfortable with internet banking, perhaps feel that they want to have a bank where they've got a presence on the high street before they move their life savings, we think that these customers are being particularly badly treated. And we think that where there's a loyalty penalty, you know, the regulator will be very concerned. And we think that it will be hard for the banks to prove that they're treating their customers fairly.
Well, you say that, but I mean, if you strip out the last 15 years and the exceptionally low interest rates that we've had, I mean, by historic standards, net interest margins at the banks they're not greatly out of kilter with where they always used to be. I mean, they're just about in line with where the banks need to make a return to their shareholders.
Well, they're certainly doing that because they've had this big windfall as rates have been rising. They haven't been passing on that increase to their savers. And I think part of it is that savers themselves need to shop around. You know, we've got used over the last decade, as you say, to earning nothing on our money and having it just sort of sit there if we're lucky enough to have any savings. And so it is important that consumers shop around. But I think it's also incumbent on the banks to make sure that they're not taking advantage of the loyalty of some of particularly their elderly savings customers.
I mean, this consumer duty feels a little bit amorphous. What sort of enforcement action would you like the regulator to be able to take if that duty is not being met?
Yeah, it's a great question because we are expecting that to come into force for existing customers at the end of July. And we've got the regulator coming in to speak to our committee this month. And we'll be asking exactly that question because I think one thing I hear time and time again is that businesses like to have that certainty ahead of time as to how it's going to be implemented by the regulator. They don't want to be caught off guard thinking they were doing the right thing and then discovering retrospectively that they weren't. And so I do encourage the regulator to show clarity as to what kind of behaviour they're expecting. But we think it's very clear that at this point, loyal savers are not being treated fairly.
No, you've just urged savers to try and shop around, if you like. But I mean, if the government of which you're a part was serious about this, then surely they'd be raising the personal savings allowance, which hasn't increased since George Osborne introduced it 8 years ago.
Well, I have been putting pressure on the government. Absolutely, it is my party in power. And they have increased the national savings and investment rates quite significantly. So last week, the rate on premium bonds went up to 4%. That, of course, is tax-free 4%. So it is one of the best offers out there. And, of course, it's backed by the safety and security of the government.
Yes, but what about the personal savings allowance, the amount of interest that you're allowed to make before you get taxed on it? I mean, that's not moved since George Osborne introduced it.
think actually it's even worse than that, Ian. I may be wrong on this, but I think it's actually going down, isn't it, next year, next tax year? So one of the measures that Jeremy Hunt's put in place, but you can correct me if I'm wrong on that one.
Yeah, pretty depressing. How quickly do you expect the banks to respond to these letters that you sent out today?
Well, we know that they're in they've just finished their second quarter, haven't they? So they're starting the third quarter. And I think what we're trying to do with these letters is to show them that we are really scrutinising their results very, very carefully. They'll be releasing their second quarter results towards the end of July. We will be going through them with a fine-tooth comb to make sure that our constituents are not being treated poorly as a result of their loyalty to the high street.
OK, Harriet Baldwin, got to leave it there. Appreciate you joining me today. Thank you.
Thank you, Ian.
That's it from me. I'm back with Business Live at the new time tomorrow of 11:30 and, of course, this time tomorrow as well. Thanks for joining me today. Cheerio.